makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. Happy Friday. I'm Francine Lacqua here in London with the conversations that matter. Now, here's what's coming up on today's program. French CPI follows Italy and Spain to a 14-month low as the ECB steps up its battle to ease price pressures. Euro area and key U.S. inflation figures also hit today. Strong U.S. data prompt traders to bet on 2 more Fed rate hikes this year. Now, UK house prices fall the most since 2009 amid soaring mortgage rates, compounding concerns from data showing living standards continue to decline. Now, first thing is first, so let's check on the markets. Actually, we're seeing quite a lot of stabilization, a lot more stabilization, certainly, than we saw the bond market repricing yesterday. The focus firmly on inflation. We did have a bit of encouraging news out of France. There's now a belief that maybe the ECB's monetary policy tightening has started to work. European stocks, you can see, gaining some 0.6%, 0.1% gain for the S&P futures. We'll have quite a lot of data, of course, from the U.S. The U.S. 10-year, 2-year yield, actually, the one that moved the most yesterday. I don't think we'd seen these levels since March of this year. And then finally, sterling 126.40. We really had a big week, not only when it comes to inflation, or inflation reading, but we heard from the Bank of England. We also have house prices today. Let's also look at the European map. Now, there's not a huge difference between Germany and the UK and the CAC 40. Over in France, we look, of course, at the riots. We had some better than expected inflation figures, but then we look at GDP forecast because of the riots. And then we have this fantastic story, actually, on the Bloomberg terminal, now looking at the fact that Russia is or actually has like a huge cargoes in terms of wheat. So they're really trying to consolidate market share for that. And of course, that means more security concerns over the war in Ukraine. Now, loads of European economic data today. UK final first quarter GDP rising 0.2% year on year, showing living standards are under pressure as incomes fail to keep pace with inflation. We also had that French inflation drop this morning following Italy and Spain. France CPI slowing to its lowest level in more than a year. And then Euro area headline inflation due at 10 a.m. UK time. So joining us now is Bloomberg's Opinions, Marcus Ashworth, and Barclays Global Head of FX Research, Themos Fiotakis. So thank you both for joining us. Themos, when you look at actually some of the inflation concern, is the market finally realizing that central banks will stop at nothing to make sure that inflation is at 2%?
Right here and right now, this is, I think, the main conversation. But I do think that from a thematic perspective, from where you put your money in, from a forward-looking perspective, this was actually the right time to position for that was 3 months ago when we actually argued that in our outlook. When you look ahead, you need to focus on the fact that in a widening number of countries, across a broadening number of indicators, inflation is losing momentum, and it's losing momentum in a more dispersed and more sure fashion than it was before. So I think that 3 months ahead, the market will try for the first time to really consolidate the peak in central banking efforts. And at the moment, even the US, which is having sort of like the most robust kind of data prints, is coming to price a level of rates which was in our forecast and was well above market expectations, but is now almost fully priced. So I think we are close to a peak in that sentiment which you described.
Marcus, do you agree with that? How's monetary policy right now? Is it just right, or is it still too low?
Oh, I do agree with that very much. That's a very concise and clear view. I clearly think the Sintra Forum showed that whilst everyone was trying to keep the optionality of September alive, and I think some people are happy saying they will hike again in September. Clearly, they are going to hike. There is definitely real concern that the economy is weakening. However, the message, which as you alluded to, is that even if they do cause, I think Europe already is in recession, but it will worsen. But by the time it comes September, maybe there'll be some clear evidence, as your colleague there is saying, that inflation is dropping across a wide range of different measures and money supply and bank lending, that they can possibly hold off. But with the Fed being so, should we say, aggressive in their rhetoric, the markets are being talked into thinking that this is going to carry on and rates are going to keep on going higher. And I think positioning-wise, we are close or around certainly fully priced into all these expectations.
So, Themos, it was clear to me in Sintra that Christine Lagarde and others kept on saying, come what may. So are they not ready to put these economies in a recession? And actually, what they worry about in the economy, it feels like it's really lending. So maybe they worry about some kind of credit crunch event down the road.
I think that there's already, and our European economics team has shown this, there's already an impact from rates tightening. And it is, even in Europe, even in the US, it's happening earlier than most past relationships would expect. For instance, in 2006, a lot of central bank peaked rates 1 or 2 years before the actual economic downturn started. We have started to see a slowdown in lending conditions already as soon as central banks raised rates close to or slightly above neutral a few months ago. So the impact is happening. In some places, particularly the smaller economies, it's happening a lot faster, but it's happening everywhere. And I think that the main problem that policymakers have, as was said before, is more the signaling and the uncertainty on the pass-through between growth, lending, and inflation. But I think that a lot of that is very backward-looking. We're all, as economists, trained to think about the forward indicators. And I worry a little bit that the focus on a lot of the backward-looking indicators like labor markets or spot inflation might actually lead to a confusing summer for markets.
Yeah, and I wonder whether we underestimate, Marcus, the fact that if they don't get inflation at 2%, it's also the credibility of the central bank, so they may over-tighten just to prove a point. Let me bring you also to my morning must-read. Now, there are three morning must-reads. Marcus, of course, Themos, and then John Authers, who basically in this piece writes, look, for the time being, however, investors don't seem to think that these higher rates will inflict an economic downturn. One explanation, John argues, would be that the economy is resilient. A perhaps more plausible one is that investors still don't buy that Fed policy is that restrictive. Marcus, is it actually not that restrictive given the wall of cash that we saw over the last 10 years? The real rates.
Wow, interesting view from John. I'm not sure I totally agree with that, but I mean, I think it is pretty restrictive, and clearly, certainly on rhetoric, Powell is making sure that he's worked very carefully and cleverly, perhaps, that any expectation of imminent rate cuts this year or even early next year, they priced out. So that in itself is even more restrictive. We don't talk about quantitative tightening very much, but that's running off at close to 100 billion per month. There's been lots of cash flows in and out with the Treasury General Account and reverse repo things, but at some point that will bite hard as well. So I think the market is aware that the Fed had a lag effect, particularly on quantitative tightening, and equally that there will be more lagged effect coming from the rate rises, which 500 basis points in a year. So I mean, I do think that the market is expecting. It's just I think everyone's surprised at the strength of the economy, in particular the labour market. So I'm not quite sure how to answer that one, but that's not. I don't see that people think that the Fed's not being restrictive enough.
Yeah, do you think, there could be some truth in that, actually, Themos, just because if you look at the real rates, I mean, they're nowhere as restrictive as actually, they could be.
I have 3 points to make to that. The first one is that if you look at any ex-ante measure of where policy rates should be for this cycle, most of these studies we've done pointed towards 3 or slightly above 3. The fact, you can say that there's a margin of error to that, but the fact that we are above 5 and then the market expects, a level of rates shy of 6, it definitely tells you that we have raised rates beyond the margin of error. Number 2, if you look at transmission mechanism, you have seen a pretty quick transmission from policy rates into market rates, into mortgage rates, and into also mortgage demand. So I think that monetary policy is working. Number 3, if you look at markets, at no point over the last few quarters has the market questioned the terminal landing neutral rate, the expected inflation, even in the US. 5-year expected nominal and inflation rates are pretty steady. The market addresses this as a mini cycle or a mega cycle, or what you call it, but small in terms of timing, but very aggressive in terms of magnitude, ones that central banks need to manage. And in many ways, the very aggressive language was more appropriate at the time where central banks were very lagging that cycle, very much lagging that cycle. At the moment, they're ahead of the curve. So I think that looking ahead, we need to think about how they consolidate that rhetoric, particularly relative to what is priced today.
Themos, let me also get your thoughts on chips, because shares in ASML are down after the Netherlands published new export controls that will restrict the company's chip-making machines from being sent to China. Now, this new export control regulation will force ASML to apply for export licenses for shipment of some advanced deep ultraviolet lithography or DUV systems. Now, the Dutch government says the measures will come into effect in September. ASML says measures won't have material impact on the outlook. But Themos, this is just one story of being more careful with, selling some of the things to China or importing, some things to China. Does that have an impact actually on renminbi or dollar?
So we've written on this exact topic, and I think that if you look at these measures in isolation, they give you a sense that they are very targeted towards a very specific group of categories of semiconductors that are very strategically important, and they're more restrictive towards the chips that would actually help China accelerate from here into certain strategic areas. So in many ways, it's a lot more like a missed potential as opposed to a hit today. But if you think about the trajectory, these things are happening more and more, and these things are happening in a more intense fashion. So it's definitely an effort to curb a certain sector and a certain growth rate in the Chinese economy. So in many ways, it is a negative for China. China is, however, changing its policies very aggressively in response to that to be a lot more self-reliant. I would note that.
All right, thank you both for joining us, Marcus Ashworth and Themos Fiotakis. Stay with us after the break, so don't go anywhere. This is The Pulse.
It is less certain that we need to keep hiking the policy interest rate in the immediate term, lest we risk tightening too much and draining too much momentum from the economy.
I want to continue to indicate my support for the work that the ECB are doing. I know that they are highly aware of the consequences of decisions that they make and factor that into the decision-making process. They have said they are going to be data-dependent in the decisions that they're making, but the objective that they have, which is the need to get inflation down, for me is a priority that we all share.
Well, Atlanta Fed President Raphael Bostic and the Eurogroup President there, Pascal Donoghue, talking to Bloomberg. Now we're back with Bloomberg Opinion's Marcus Ashworth and Themos Fiotakis from Barclays. Themos, give us your outlook. First of all, thank you both for sticking around, but give us your outlook for the UK economy. So we have, as always, a bit of good news, a bit of bad news, and then in the middle you have the Bank of England having to try and navigate through this. UK living standards are resuming a decline, and this is, of course, a fresh blow to the Prime Minister. But at the same time, we have a Lloyd survey saying UK business confidence is rebounding. So what's the state of this economy?
I think that the economy is a lot more stable and a lot more uninterrupted in its growth and potential than a lot of the stories make it. I think the stories are a lot more volatile than the economy itself. Of course, if you look at it on an average basis, there's a squeeze in the average household in terms of living standards, but you have to keep in mind that when you have a very strong labor market, the benefits are broadening, so more and more people are getting better off. And in fact, this is one of the big items in the UK. Because of supply constraints that have come up, particularly post-Brexit, the labor market has been very tight. Wages have outperformed other regions. And despite the fact that the output hasn't increased as much, you have definitely seen a more inflationary output per unit produced. So overall, I think that what the market has actually interpreted as stagflation, as a cost of living crisis, is actually an economy that is operating well above capacity. And finally, the market has actually repriced that quite aggressively in rates. Now, whether it's pricing it 100% accurately or not, I tend to think that by now it's fully priced. So the risk is that we get one CPI or one data that is slightly softer, and the market removes a little bit of the tightening and weakens a little bit the pound. But generally speaking, I think the direction of travel has been suitable for what the economy is doing.
Marcus, what's your take? So the Bank of England last week was pretty decisive with 50 basis points, and frankly, it was probably the right thing to do. It had little other alternative given that inflation print. What does it do from now?
Well, I mean, Bailey was very careful, again, to make clear that he doesn't see August 3, that there is any expectation of what they may do. They will decide then and there. And bear in mind, that will be a quarterly monetary policy review. I suspect, as Thomas has pointed, there will be certain things they can lean to by then. We know that the July inflation number should be a lot better, courtesy of electricity prices dropping out a bit further. So I just think everything has been delayed in the UK. It's the way we calculate the inflation data, the way we regulate our electricity market, and indeed the ONS doesn't recognise perhaps certain things which would be recognised in Europe, and likewise the way that governments have stepped in and, should we say, saved the consumer and added to their own debt, which we haven't done in that quite the same way in the UK, or certainly on a lag basis. It's creating some strange numbers, but the housing market is surprisingly robust still, and the labour market is strong. It's just a question of the economy is not really going anywhere. But I do think it's held up better than I think you'll start to see in Europe. The gap will widen between the UK and Europe as far as growth is concerned.
All right, thank you both, as always, for joining us. I hope next time we do it in person. Bloomberg Opinion's Marcus Ashworth, Barclays, the Global Head of FX Research, Themos Fiotakis, joining us. A wide-ranging conversation. Coming up, lots of UK data this morning. What does it really tell us about the nation's economy as it deals with sticky inflation? We discuss more on that next. This is The Pulse. The conversations that matter and the insights you need. This is A Pulse. I'm Francine Lacqua here in London. Now, we've had lots of data out of the UK this morning, including GDP and house prices. The numbers come at a tricky time for the UK economy as the nation's central bank, of course, recently hiked rates more than expected, 50 basis points. A lot of economists say, look, they didn't have a choice really to do that if they want to curb inflation after a pretty ugly inflation print the 24 hours before that. Now, for more details, Lizzie Burton, our UK correspondent, joins us. First of all, Lizzie, I'm confused about house prices. I mean, are they up, are they down, or are they stagnant? Because different surveys tell us different things.
Well, the big picture Bloomberg Economics says is that this is the calm before the storm. The nationwide data that we saw today shows it's the biggest drop in house prices, or falling the most, since 2009. So this is a bad one. And we had the BOE mortgage approvals data yesterday. You saw people basically trying to pay their mortgages off early because they want to escape these jumbo hikes that are coming. So the big picture Bloomberg Economics says is that you're still going to see a house price correction coming. You mentioned that GDP data. It still is anemic. Yeah. So it's kind of mixed. It's not a recession, but it's nothing to write home about.
Yeah. And cost of living crisis. So that's getting worse, and that's a huge political hot potato for the Prime Minister.
Exactly. And you saw more about that in this GDP data. So the household income per head, disposable income per head, I should say, fell 0.9% when adjusted for inflation. So living standards falling. It is not what Rishi Sunak wants to be the backdrop for going into election, especially when it was one of his top 5 promises to grow the economy.
Yeah, I mean, out of the promises, and this is what we spoke about last time, I mean, they've also promised to have inflation. I don't know whether there's any fiscal, they're staying the plan, but how does the government do that without, are they working more with the Bank of England?
Yeah, I mean, that's a conversation that we've been having over the past week, and economists talking about it more and more. All of the options are politically unpalatable, and that's why you've seen the Chancellor talking to the regulators, the energy, the supermarkets, the banks regulators. He's criticised by the opposition for that being too soft. You know, the companies are kind of saying, on the one hand, they are not guilty of greedflation, but on the other hand, telling shareholders, oh, our margins are healthy, invest in us. How can that be enough of an intervention from the government, as you say, when its top priority is to halve inflation by the end of the year? But it's not just those 5 priorities that are wreaking havoc for the Prime Minister this week. You've also had the Rwanda policy to send illegal immigrants there, ruled as unlawful.
Is that a huge setback, actually, for the government, or does it just make them look like they don't really know what they're doing?
It just makes the mood look worse, doesn't it? It is one of the top priorities in the sense that Rishi Sunak promised to stop the boats crossing the channel. But then you've also had the Thames water issue as well, potentially facing nationalisation, which comes back to the inflation issue. So they're all tied up together. A very difficult week for the Prime Minister.
Yeah, Thames water. I know you covered it yesterday. We need to spend a bit more time on just looking at some of these companies that have so much debt out there and what that means in terms of refinancing. Lizzie, thank you so much as always. Lizzie Burden, our UK correspondent. Now, coming up, we speak exclusively to Benoit Bazin, the CEO of global construction firm Saint-Gobain, on everything from inflation to supply chain issues. That's coming up next, and this is The Pulse. French CPI followed Italy and Spain to a 14-month low as ECB steps up its battle to ease price pressures. Now, euro area and key U.S. inflation figures also hit today. Strong U.S. data prompt traders to bet on 2 more Fed rate hikes this year. Plus, UK house prices fall the most since 2009 amid soaring mortgage rates, compounding concerns from data showing living standards continue to decline. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, French inflation has slowed to the lowest level in more than a year, but the nation's economy is still set to record only lackluster growth this year. Now, the economic outlook is impacting many businesses in France, which are seeing rising costs, among other issues. Well, I'm very pleased to welcome Benoit Bazin. He's the Chief Executive Officer of the French construction firm Saint-Gobain. Mr. Bazin, thank you so much for joining us on The Pulse this morning. There's a lot of concern about the world economy, about the fact that interest rates are going higher. How confident are you about your outlook in the next 12 months?
We are confident about the outlook. We guided for the year in terms of moderate decline in our volumes, with indeed a negative trend on new build, but very good resilience on renovation. As you know, we are very much driven by renovation, energy efficiency. So indeed, we are confident with our guidance for the full year, and even at our AGM in early June, we said that we will have a double-digit profit margin in the first half.
At the same time, there has been some pushback from some countries on some of these renovations just because of the cost of living crisis. So how do you see that outweighing some of the benefits of needing to do renovations to be more compliant for Saint-Gobain?
The renovation that is driving Saint-Gobain is related to energy efficiency. All countries have realized that with the higher cost of energy, the payback for such energy efficiency renovation is much better than what it used to be 5 years ago. So we badly need to do it. With the good energy efficiency of the building envelope, private and public buildings, you can drop 70 or 80% of the energy bill. So the push for that continues. There are more regulations, more also standards, minimum energy efficiency, and I was happy also to see that the Parliament in Europe, mid-March, voted for acceleration in terms of minimum energy efficiency regulations across all countries in Europe. So we see more acceleration on that, public money towards public buildings than the opposite.
But are you, Monsieur Bazin, seeing the cost of living crisis impacting certain businesses and certain households pushing back renovation?
Well, of course, we have to make sure that the households with low income get more help. And this is precisely the purpose of mechanisms like MaPrimeRénov' in France, which is targeted towards helping the low income households. So I think we need to make sure we dedicate more of the public spend, more of the tax credits, of the subsidies towards low income people, so that we have a fair transition and a fair energy transition towards buildings, notably on the low-income people that indeed require more support and more help.
What about inflation costs for your own business? If you look, for example, at making glass, which is one of your huge units, that requires a lot of energy. How problematic is this going forward?
We have managed it very well over the last 2 years. And this is why the margin of Saint-Gobain continued to increase in 22 versus 21. To give you where we are, between the summer of 21 and end of 2022, we had 5 billion euros of inflation on raw materials and energy. So very significant. But nonetheless, we improved our margin. For this year, 23, we think we'll have around 800 million euros of inflation on raw materials and energy. So as you can see, we are in a much lower inflation environment. We continue, of course, to have some pricing actions. But I think in our universe, on energy and building materials, we are not far from a plateau. And this is why we are confident about the margin guidance we gave for the year 2023 for Saint-Gobain.
On supply chains, can you tell me where the bottlenecks are and what you can do to actually mitigate some of those supply chain bottlenecks?
We have been very well organized within Saint-Gobain on that, keeping in mind that I reorganized profoundly the group 4 years ago. We are organized by country, and our country CEOs, 90% of them are native from their country, drive the business. They have full responsibility, including on their supply chain. So the supply chain that we have is local. Is it Poland for Poland? It's in Vietnam for Vietnam, in Canada for Canada. We have less than 1% of our supply chain that comes from China. So we are very local, multi-local businesses, and therefore very much immune against the geopolitical risk and against supply chain disruption. In the last 4 years, we never shut down a job site nor a customer because of the supply chain of Saint-Gobain, against the COVID, against energy inflation, against some supply chain disruption that others could have faced.
How much are you expecting to put investments in the US thanks to the Inflation Reduction Act, which makes it very attractive for companies to renovate and build some of the renewables there?
Indeed, and I must say that I've been very happy to anticipate that because we started to invest heavily in North America in 2019. Over 4 years, we have spent $6 billion of both acquisitions and capital expenditures in North America on CapEx for new plants. As we speak, we built new plants in North America, mostly for building materials, because IRA will be good for the US economy, good for the jobs, and therefore good for housing. We see housing starts in the US being up in May versus April. So that's the trend we are seeing, good resilient housing market in the US. And also we have made some very successful acquisitions. The latest one was in Canada just a few weeks ago, and we have been very happy to double our size in Canada in just 2 years. And overall, North America will make more than 30% of our profit in 23, like in 2022. So a big change, but we started 4 years ago before the IRA.
So, Mr. Bazin, I mean, the Canadian roof products maker acquisition was quite, big, but you also did deals in Malaysia, Egypt, and other ones. What's next on the M&A front?
Well, we are happy to grow a lot outside of Western Europe because we have already a big presence in Western Europe. So the motto to our European teams is share of wallet. Make sure that for any customer of Saint-Gobain, you increase our share of wallet for our customers, and we are doing that. We outperformed our competitors over the last years, including again in the first quarter on organic growth. The growth in terms of acquisitions, new capex, we had 78 new plants in the last 4 years. 70% of that was in Asia, India, emerging markets, and North America. So a lot dedicated outside of Western Europe. And I remind that last year, 62% of our profit came from North America, Latin America, Asia, emerging markets, so outside of Western Europe, where we are accelerating and doing very well. India is country number 3 for Saint-Gobain, US being first in terms of profit.
All right, Mr. Bazin, as always, thank you so much for the insight. Benoit Bazin, the Chief Executive Officer there of Saint-Gobain. Now, we're also getting some news on Apple. We've been waiting for this moment, especially one of our editors, TV Dan, reminds me every morning, make sure that you hit that when it happens. It was on the verge of becoming the first company to ever achieve a market value of $3 trillion. It has gone through. So the iPhone maker, rose, I think, some 0.7%. It didn't take it much, but it basically means that it has an equity capitalization of just above $3 trillion. Now, it could go up a touch. It could actually go down. But look, if you look at what analysts have been telling us, a lot of the portfolio managers saying that it's not a surprise that Apple is actually the first to reach that milestone. Big tech, in fact, has rallied through 2023 with the NASDAQ 100 index up some 37%. So the excitement over artificial intelligence has also fueled much of the big tech's gain. And then Apple going through that very important landmark, that milestone even of $3 trillion in market cap. Coming up, the former UK National Security Advisor, Peter Ricketts, joins us to discuss the fallout in Russia this past week. This is The Pulse. Now, investigators have questioned one of Russia's top generals about the failed mutiny that presented the greatest challenge to President Vladimir Putin's quarter-century rule. Bloomberg has learned that Sergei Surovikin was quizzed about his links to Wagner mercenary leader Evgeny Prigozhin. Now, with President Putin's authority under attack last weekend, I look at the consequences this could have on stability inside the world's biggest nuclear power. Over 24 hours, Russian President Vladimir Putin faced the biggest threat to his almost quarter-century rule. The uprising has raised questions about Putin's grip on power, the influence of hardliners, and their even more extreme view on the war in Ukraine.
This is probably the most overt display we've seen so far in terms of a public challenge to his authority. It must also have raised concerns about whether Putin had total control of his security services if this convoy was allowed to move again unhindered with speed towards Moscow.
I think there may have been an expectation that he would gain further support from Russian soldiers, and that maybe that this would spark protests in other Russian cities. And I think that may have played into the fact that he decided to turn back.
These events have thrown Russia's internal security into question, a worrying prospect for NATO given its nuclear arsenal. After 16 months with little success on the battlefield, and now a Ukrainian counteroffensive followed by the mutiny of his own forces, Putin's future may be in doubt.
You can imagine there'll be lots of conversations going on behind the scenes amongst the elite in the business and the military establishment about whether to continue to support Vladimir Putin into re-election next year.
Well, many people think that this is good for Ukraine's counteroffensive, that it shows a sign of weakness. There have been some reports that Ukrainian forces have made incremental territorial gains, but it's really unclear at this point. The alternative view is that actually, because of the weakness and the turmoil in Russia, that the Russian Defense Ministry and the Kremlin will decide to strike back even harder and do something out of the ordinary to distract from the domestic political struggles.
Well, to watch the full report, go to Bloomberg Quick Take on Bloomberg.com and Bloomberg on YouTube. Now let's get more with Peter Ricketts. Lord Ricketts, he was Britain's first national security advisor, former permanent undersecretary at the Foreign and Commonwealth Office, and former UK ambassador to France. So, Lord Ricketts, thank you for joining us. It was a pretty incredible 7 days, how fast this happened and then how fast it unraveled. How weakened is Vladimir Putin now?
Well, I think it has definitely weakened him. As you say, nobody had been expecting this kind of open challenge to Putin, who has been a pretty effective authoritarian ruler in terms of ensuring no threats to his own position domestically. His tactic was divide and rule among his subordinates, and that seems to have gone far too far in the case of Prigozhin. He was left with far too much room to maneuver, to the point where he was actually open to challenge openly the Russian military generals. So it's a sign of weakness. Putin had to turn to Lukashenko, the president of Belarus, to get him out of the fix and get rid of Prigozhin into Belarus. My own feeling is the Russian elite were very concerned that Prigozhin was channeling the anger of many rank-and-file military at the obvious failures of the Russian campaign, and that therefore it would have been dangerous to take him on. So that is all a sign of weakness. Now, I'm not suggesting that Putin is going to fall imminently, but I think his grip on power has been weakened. The sense of invulnerability around him has been badly tarnished, and therefore those who have ambitions for the future must be beginning to think, how can we manage this transition? How can I secure my own safety as the purges come, as they are almost bound to do?
So, Lord Ricketts, how quickly could Vladimir Putin go? And is there an obvious heir?
I mean, I don't think anybody can predict that. We didn't predict this sudden Wagner eruption into the Russian domestic space. And Putin will be doing everything possible now to weed out those who, may be plotting against him. I think the disappearance of this General Surovikin is related to the fact that he was close to Wagner. He was the link man between the Russian General Staff and the Wagner Group. And so, therefore, he's now under questioning. And anybody who's had any links with Prigodzhin and his operation will now be worried. So, I mean, it still could be a matter of years, but it feels to me like we are now in the end game of the Putin regime.
Does Vladimir Putin become more dangerous in this end game?
Well, he's been pretty dangerous up to now. I mean, he's been cracking down on dissidents and opponents within Russia for at least a decade. He's been throwing everything he can at the war in Ukraine. So I don't really buy the thesis that things could now get worse for Ukraine because Putin will feel the need to lash out. He's been lashing out for over a year. I think this has to be good news for the Ukrainian offensive. To have all this going on behind the backs of the Russian generals and the Russian forces must be destabilizing for them. Wagner themselves have been pulled out of the Ukraine battle. They were some of the most effective Russian troops. They were so brutal that they perhaps had better effect than many others. So all this, I think, weakens the Russian defensive operations. The issue always is timescale. And with an authoritarian dictator like Putin, I don't think we outside can ever know when the decisive moment will come, because if we knew, he would know and he'd do something to fix it. It will come as a surprise when it comes, but I think we are now in that period.
So, Lord Ricketts, how difficult is it to understand the level of morale in the Russian army right now?
It is difficult because, of course, news is very controlled. I think there are people who follow the Russian military bloggers and some of the postings of the Russian rank and file. And there's clearly been an enormous amount of frustration with the conduct of the war. And that's what Prigodzhin was tuning into, that sense that the generals have messed up, that a lot of young Russians have died, but absolutely no gain at all in Ukraine. How far that spreads into the broader population, I mean, we just don't know. I suspect most Russians try to stay as well clear as possible of anything political for fear of their own safety. But I think there's probably an underlying anger at the failures and the humiliation of the Russian forces in Ukraine, because that's what it's been, which will play out in due course.
But Lord Ricketts, can you say with confidence that actually Prigodzhin, did a U-turn because he did not get enough support from the generals, or was there really a deal struck?
It's mysterious, isn't it? My feeling was that it was all quite impetuous. I think Prigodzhin was furious when the decision was taken to demand that Wagner effectively wrap themselves into the Russian armed forces, and that the Wagner forces signed contracts to become part of the Russian armed forces. He saw that as a threat to his lifeline, his funding, his support from the Russian MOD, and decided to act. And it was an extraordinary gamble that he took. The fact that he had such an easy time of it at Rostov-on-Don, where he was able to effectively occupy the Russian command post, suggests that there was a degree of complicity among local forces. I think he probably got to the point where he was massively exposed halfway to Moscow, miles from his own bases. And Lukashenko or somebody said to him, look, chum, either you come to Belarus or it's the end of you. And he decided that discretion was the better part of valor.
Really extraordinary insight from you, Peter Ricketts. Thank you so much for joining us, former UK National Security Advisor and former UK Ambassador to France. Coming up, China and the war in Ukraine are on the agenda as EU leaders meet in Brussels. So we're live in Brussels next. This is Bloomberg. Now, the conversations that matter and the insights you need. This is The Pulse with me, Francine Lacqua, here in London. Now, EU leaders have started talks on the final day of a summit in Brussels after agreeing on future security commitments for Ukraine. Switching from the war to economic security, EU leaders will also focus on China today. Now, for more, our correspondent on the ground, Maria Today, who's been following the meeting, of course, for us and all of these stories from the very beginning. So, Maria, Ukraine aspires for NATO membership. Will it actually get it?
Yes, Francine, absolutely. And this is the fundamental cornerstone of their foreign policy. They continue to say there is no better deterrence against Russia than NATO membership. And yesterday night, Francine, in a meeting which ended in a very European way at 1:30 in the morning, European leaders again repeated, yes, we stand with Ukraine, but also went a step further and now point to future security commitments. The issue, however, Francine, is that the framework is not clear. And when it comes to the NATO question, it's also not clear because the Ukrainians obviously know they will not join as the war is going on. NATO also has a very heavy internal debate as to what kind of security guarantees they can provide. And also all of this will lead to the real meeting and the tension point here, which is the NATO summit in Vilnius. Will there be consensus? Will they promise Ukraine, yes, you will join, not now, but after the war? That is exactly what the Ukrainians will want. That is still a question that is very much up in the air. And frankly, there's quite a lot of fear still around this idea of Ukraine and NATO for a lot of member states too here.
Yeah, I'm sure there is. Leaders also debating the role of China today. So, Maria, how much will de-risking feature in these discussions?
Yes, and Francine, you see the common thread here from security in Russia to now economic security in China. And we know that von der Leyen, the head of the Commission, has been clear now in her proposal, no decouple, but yes to de-risking. And I asked Latvia's Prime Minister, Mr. Kariņš, what does that mean when it comes to European policy? And this is what he said. Let's take a look.
We've never really had a European China policy, but it's in the making. And the mantra is the de-risking, taking the lessons that we've learned rather painfully on our previous high energy dependence on Russia.
And that was Latvia's Prime Minister, Mr. Kariņš, again pointing to the idea that Russia does offer lessons about de-risking when it comes to crucial issues like security and energy. This conversation in China continues today. But again, one of the issues here is that they all say, yes, we agree with the idea of de-risking. But what does de-risking mean for every member state? And we know there's big differences of opinion among the EU. So today, again, expect a lively debate, hopefully not until 1 a.m. in the morning. We do want a weekend on Bloomberg, but expect this to be another heavy debate.
Yeah, Maria, thank you so much. Only Maria Today can actually pull it off for us. So, to bed at 2 a.m. and then up at 6 a.m. Up next, Bloomberg Surveillance Early Edition with Kriti Gupta in New York, Danny Berger in London. They'll have a full roundup of some of the news out today. We have a lot of U.S. data, and then we also have a bit of UK data at 10 a.m. What does this mean for central banks? We also look at bonds around the world, and this is Bloomberg.